Money from around the world continues to pour into Switzerland and into Swiss bond markets, driving yields in it down to negative levels and keeping them that way. Because Switzerland remains a key global money center, what's taking place here, this drive for safety, is more about what's happening around the rest of the world and fears about it than strictly what's taking place in Switzerland itself. And markets are not waiting for the Swiss National Bank to drive into negative policy rates either, which actually gives us a sense about what we should expect for U.S. Treasury yields and global bond markets and interest rates moving forward from here. And we're not talking about inflation. Now, contrary to what you've been told, negative interest rates are not stimulus, not in any way. A negative bond yield is instead a liquidity premium, a safety premium. That is, it's a rate at which bondholders are willing to pay just to preserve their funds. The greater the fear that they have about a range of global factors, the more they will be willing to pay the negative rate premium, especially in a place like Switzerland. Now, as far as the Swiss National Bank goes, the country's central bank, it had already dropped its policy rate to 0 in June, which was merely following the bond market anyway. And while the S&P paused in September for the first time, the latest data out of Switzerland strongly indicates the central bank's pause will be a short one. Now, where this truly applies to the rest of the world beyond Switzerland is that the Swiss curve that's now anchored in negative rates at the front, it tells us something very important about what we can expect for global bond markets, including helping us answer how low rates in treasuries and elsewhere might end up going in this cycle. Everything about Switzerland, from its bond yields to inflation figures and economic circumstances, the Swiss franc as well as the Swiss National Bank, all of them, they're all tied to global conditions because the banking sector there is a world money hub. So if you see something out of the ordinary in Switzerland, like negative bond yields, immediately you have to take notice because first of all, it's not really about Switzerland. And second of all, it's not going to be out of the ordinary for very long because what's going to become ordinary are all the negative factors that drove Swiss rates to be negative in the first place. When the entire world thinks it needs to take shelter in these Swiss assets and pay a premium to do so, that tells you a lot about what's happening around the rest of the world and perceptions among the Eurodollar participants. And when they're thinking this way, you definitely have to take notice because it answers a whole lot of questions about today, as well as interest rates, economic conditions, deflation, and a whole bunch more tomorrow. Now, the first thing you immediately notice about the Swiss bond curve is that the banking crisis in 2023 sticks right out on it. You can clearly and obviously see not just when it was, but more importantly, take notice of this, how it permanently changed the trajectory of the entire market. That banking crisis is, well, what we're taught was nothing more than a footnote. A few U.S. regional banks that failed for being stupid with government bonds during Fed rate hiking. Nope. There was a lot more to that story, including, as everyone always forgets, Credit Suisse. So one of the major Swiss banks failed, which sent a signal to the rest of the monetary world, forgot how to grow was going to create casualties, not rate hikes, the global economy, which wasn't recovering, which had been impoverished, and how there would be negative worldwide consequences for all of it. The bank volatility in March and April of 2023 was nothing more than a signal to that effect. It was about risk, not central bank policies. And from that point forward, and by the way, you see this in every single bond market, from Germany to, yes, U.S. Treasuries too. Ever since the 2023 banking crisis, bond markets around the world, they shifted, they changed. They started to price lower rates as a foregone conclusion. Not immediately, but over time. That's where the world was going to end up. And the Swiss market, as usual, was leading the way in that direction, sending one of the clearest signals out of everything. Again, you can literally see where the whole marketplace changed, making up its mind there would be zero inflation risk moving forward, and that given enough time, even central bankers would eventually have to figure this out. And by May 2023, another powerful signal, the Swiss bond curve inverted, and it almost never inverts. It was a powerful warning that everyone missed, thanks to economics and central bankers who tell you stuff that's either not true or entirely backward. And this is exactly why Eurodollar University is having a webinar on Tuesday, October 14th at 6 p.m. Eastern Time, so that you can start to unlearn all the garbage that economics and central bankers have given you through the financial media. They tell you things that either aren't true, and many times purposefully, or just completely backwards. So our webinar, we're going to go through the hidden truth, and it really is the hidden truth, behind what interest rates actually tell us, so that you can decode what interest rate signals mean, and therefore be better prepared to handle what's coming at you. Because this is not just about looking backwards. More importantly, we're looking ahead like we're doing here with Switzerland. So join us Tuesday, October 14th, 6 p.m. Eastern Time, the hidden truth behind interest rates. There's a link in the description to sign up. It will be well worth your time to attend. So after 2023 and the banking crisis and the Swiss curve inverting, Swiss rates made another big move with the rest of the global bond market in June of 2024, starting the next stage, or stages really, in the forgot how to grow saga, the one that's now remembering unemployment and deflation. So what everyone missed, thanks to so much mainstream media attention on the supposedly hawkish Fed rate cut back in December of 2024, was how the Swiss 2-year yield had already dropped to zero and even slightly negative. This was the same time the dollar was going nuts, screaming higher and signaling that yes, deflationary conditions worldwide were taking place, they were getting bad, thereby driving demand for global safety and right into the front end of the Swiss bond market. But then after that kind of abated, you can sort of make the claim that some inflation and worry, tariff inflation worry, hit the Swiss market from January to mid-March of this year, when yields climbed and they retraced some of that prior downturn. So if the market was ever thinking tariffs were going to be inflationary, that was the one and only time, though it was more likely just the deflationary money pressure in the Eurodollar world backing off, which relaxed the urgency to buy Swiss safety. But either way, once the trade war disturbance showed up again in the middle of March, yields in Switzerland slid all the way back down again. The twos went negative for the second time on April 7th, right in the worst part of the market meltdowns, showing once again the global money nature of Swiss bond rates. But here's the thing. While the stock market immediately started to rebound after the tariff delay announcement, Swiss yields kept sinking. The twos kept getting more negative, and then the other parts of their Swiss curve, they would go below zero as well. By early May, the fives were slightly negative and would revisit that toward the end of the same month. There was finally a modest retracement, a second modest retracement, which pushed the fives positive and made the twos less negative, the same time as the whole sell America garbage that came up. In other words, as I showed you in a recent video on the dollar exchange value, during May and June, in the case of Swiss bonds, though it was just June, in May and June, that small brief window which marked the period in between remember how to fire and deflation stages. So the first stage culminated in the chaos of April and its aftermath, and it included all of the dollar deflation that started back in November and December. But then there was this pause before the next stage, the one that we're in, which renewed starting in early July. Switzerland's bond market picked that up right away, with the two sinking back more negative, and then the rest of the curve following up with lower rates just a little bit afterward. The 5-year, the yield there is just now above zero and sliding along close to zero, while the 10-year maturity is seeing yields around 20 to 25 basis points and moving progressively lower from there. Before we go on with our video today, let me ask you a question. What if your gold could actually pay you every single month in more gold? That's what today's video sponsor, Monetary Metals, lets you do. And here's how it works. You still own the gold, it's still in your name, it's fully insured, but instead of just sitting there doing nothing, it actually starts working for you. Monetary Metals has built a system that turns idle gold into productive gold, earning real yield paid in physical gold, not dollars. No selling, no trading, no converting. You keep your gold, and every month you get more of it. It's a simple idea, but it solves a big problem. If gold is money, it should act like money, and now it finally can. If you're a long-term gold holder looking for a smarter way to store value, check them out at monetary-metals.com/Snyder. Again, that's monetary-metals.com/Snyder. I highly recommend booking a call with them today to see if they're the right fit for you. We thank Monetary Metals for their sponsorship, but now let's get back to the rest of our video. Now, the fact that the Swiss National Bank met last week and decided not to move rates at this meeting hasn't deterred the market one bit, because Central bankers follow the markets, not the other way around. And the markets are pricing forward conditions that at some point, even central bankers won't be able to miss. That's the whole point of the Pringles can. Now, at its September policy meeting, the SNB opted not to adopt a negative rate policy after having discussed it previously. Now, it had already dropped its benchmark rate to 0 at its previous quarterly meeting in June. But back then, SNB's head Martin Schlegel said the bar for going negative would be very high since no one likes negative rates. And that's true in the bond market, which already tells you something about how conditions globally are being perceived if money keeps flowing in to pay that safety premium in the Swiss marketplace. And a key reason why the S&P opted to stay at 0 and pause for the first time in their Pringles cycle is a small, and I mean small, upturn in consumer prices in Switzerland. Switzerland's CPI dropped to 0 year over year in April, and then slightly negative in May at 1/10, but then the annual rate turned positive straight away the next month of June at 1/10 positive before accelerating by the tiniest amount to 2/10 in July. But that's where it has stuck for both August and now September, which is the latest update that was released just today. And the reason it's stuck near 0 rather than accelerate like everyone was expecting is that on a monthly basis, Swiss consumer prices are already declining all over again. Yeah, it wasn't anything more than a temporary uptick that was driven mainly by some positive monthly price changes in the period between February and June, the artificial tariff distortions that created a small burst of activity, which all these central bankers believed was their economies responding favorably to their prior Pringles policies. And predictably, all that is rolling over again, even if it's a shock to economists and central bankers. And again, that's why it's so important to read these market signals for yourself and not let these fools fool you. So the Swiss National Bank took a small positive annual CPI as a reason to pause and to see if the rate cuts were going to be working for more than the short run, when the markets have already said that's not how interest rates actually work. In other words, on consumer prices alone, the S&P is going to be adopting NERT at some point. The only question remains when. And the same is true for the Swiss franc, which remains uncomfortably high against the US dollar. S&B takes the franc into account, especially against the euro, when deciding on its interest rate benchmark changes. So when the franc is judged to be too high, according to S&B's perspective, they will move their interest rates around to try to dissuade money from doing what it's exactly doing right now, even to the point that they drive rates negative, trying to disincentivize global money from flowing into Switzerland to maybe counteract the strength in the franc. But the strength in the franc is really this risk aversion and growing concerns around the rest of the world, and that is far stronger than any interest rate policy or market rate result in Switzerland. That's really what all this is about from the S&B and its policy rates. All of these factors are tied together. When the monetary world starts to get really worried about the general state of the rest of the world, it seeks safety in places like Swiss money. So the Swiss franc starts to rise as the currency is swapped into francs in order to buy Swiss assets like government bonds, whose yields then decline and even turn negative, as we're seeing right now. And as all that happens, the Swiss inflation rate becomes disinflation, since a lot of it is tied to the franc anyway. Plus, when there is heightened demand for safety around the world, the global economy is in all likelihood going to be falling off to begin with, further depressing Swiss prices and its economy. So, global safety demand goes up, the franc goes up with it, Swiss yields go down, Switzerland inflation becomes deflation, and the S&P drops its policy rates in response to all of those, which are actually one big trend, one big Eurodollar trend. So when money pours into Switzerland at such a pace that it turns market yields negative, and then eventually the Swiss National Bank does the same thing, following everything up, you need to pay attention to it because it's not really about Switzerland. What we're looking at is Switzerland's reactions to the rest of the world. Now, I did a video a little over a week ago where I went through what was on most people's minds, the two main questions they always want answered. How far will the Fed end up cutting once it's forced to completely stop waffling and completely stop searching for tariff inflation that's never going to come? And how low will the 10-year U.S. Treasury yield end up going when everything shakes out? What I showed was that we have some market tools to guide us toward not necessarily definitive answers. We're never going to get definitive answers, but using our knowledge of rates and forwards markets, we can sketch out some probabilities. And that's what I did in the video. I started with swaps to give us a sense of short-term rates. And And that one was relatively easy. The rate swap market says the Fed's going to go ultra low and stay there ultra long. That might mean 1% or less from Fed funds target, maybe even going as far as zero itself. But then for the 10-year and the rest of the yield curve, we had to apply a historical bull steepening factor that was taken from historical examples of bull steepening cases. When what we're seeing right now in long-term treasury rates is hardly unprecedented, even though everybody wants to sell you that this is some kind of treasury rejection or sell America stuff. No, it's just bull steepening, and it's typical bull steepening. In fact, it's actually kind of atypical bull steepening in the fact that the amount of steepening on the curve has been less than the historical average. And there is a reason why, or a couple of reasons why that's the case. Now, I use the record low copper to gold ratio as an illustration of those negative factors, which would argue the bull steepening case we're in will end up being a lot less steepening overall when all is said and done. And this is where the Swiss curve comes into it. It's another critical signal that yield curves everywhere, not just in Switzerland, yield curves everywhere will come out comparatively flatter, even at their steepest points in this current bull steepening process. When the front end of the Swiss curve is anchored in negative rates, that's a sign of flattening. That's heightened demand for safety and liquidity, which cuts into global growth and inflation expectations, which are what ultimately drive global bond yields. And since negative Swiss yields aren't about Switzerland, instead the rest of the world, bull steepening in Switzerland with the front end anchored in the negatives is an unmistakable sign of lower growth and inflation expectations, looking out well past the short term. And we've already seen this happen once already. If you go back to 2011 and 2012 and the aftermath of 2011 and 2012, or what we call here Eurodollar number 2. And Eurodollar number 2 is really just the second global monetary outbreak, deflationary outbreak, the second one following the first one, which was the global monetary, not financial crisis in 2008. It was basically a systemic money and banking issue that impacted the entire world, and as a banking center, Switzerland was front and center in it. So the Swiss twos first hit negative rates on November 3rd, 2011, just as this Eurodollar number 2 thing was really flaring up and getting bad. It was just a single day at the time, but then from December 9th of 2011, and December 9th is an important day in Eurodollar number 2, which we're not going to get into here, the Swiss 2-year went negative for a short burst again, and then it went negative and had even deeper negatives around May 2012, never really getting above zero at any point along the way. That heightened demand for global safety never left, as the Swiss 2-year yields remained near zero and even occasionally negative, more frequently negative, over the next couple of years following that. The S&B, by the way, it wouldn't officially adopt a negative interest rate policy until December of 2014. In other words, the market was way ahead of the central bank, as is usual. More importantly, though, while the Swiss curve was anchored around negative yields, yield curves worldwide would remain much flatter than they had been in normal recovery, even reflationary periods from before 2008. Why? Because there are consequences to growth and inflation from periods when demand for safety gets to be that overwhelming. The seriousness of deflationary fears that drive rates in Switzerland under zero because of actual deflation conditions are likely to be a long-run drag on growth potential. Curves are naturally going to flatten out as growth potential is harmed by deflationary outbreaks. So wrapping this all up, we know Switzerland is a key global money center because money flows in and it flows out in Switzerland, and money that's flowing in and flowing out of Switzerland, a reflection of global perceptions and global conditions as they might start to arrive. So when the Eurodollar world is worried about those global factors, money pours into Switzerland seeking safety. The franc rises, Swiss market interest rates fall, even turn negative. Consumer prices there tend to do the same, and eventually the Swiss National Bank adjusts its policies in the face of all that, which actually means, when you stop and think about it, the S&B's moves in interest rate policies are responses to the consequences of those global Eurodollar factors. So in the bigger picture, because of all that, the behavior of the Swiss curve today tells us a lot more than what's happening today in Switzerland. Negative rates are already there and they're already persisting as the next stage in forgot how to grow, remembering unemployment and deflation is right here. If you do want to see all of the steps and all of the information that went into our estimates for how low rates can go, it's in the video link below. As always, thank you very much for joining me. Join me on Tuesday, October 14th, 6 p.m. Eastern for our webinar, link in the description. Huge thanks to Eurodollar University members and subscribers. And until next time, take care.